Is the stock market risky right now? Let's discuss. So, hey everyone, welcome back to Upside Down Data. Today I want to talk about the stock market and whether or not it still seems to be in a bubble that's about to burst, or if things might look a little bit different. So certainly there's a lot of narrative being thrown around there on Twitter and elsewhere, saying that the stock market, even after the correction that we've seen, is still massively in a bubble, that this relief rally is going to fold over and we have to go and have another crash like we saw, for example, in 2008, some massive recessionary drawdown. So I want to talk about a model that I've been playing around with applied to in this case, S&P 500 and what it says. So this is a version of the upside downside potential indicator, UDPI, but I've just retooled it a bit to apply to the stock market instead of crypto, which is usually what we look at it in regards to. And I think this gives some interesting insight. So first of all, if you just look at it, you can see that it tends to do a pretty good job of identifying high and low risk points in the market. So if you're not familiar with the UDPI, high levels are suggesting high risk, or that's when the upside potential is getting minimal, downside potential is quite large, and then vice versa. -5 is when the upside potential is quite large, downside potential is quite a bit lower. So you'll note that at significant low points in the stock market, it will turn green, signifying low levels of risk, and then at significant topping out points, it turns red, suggesting higher levels of risk. Or another way of putting it, that there's notable downside relative to the upside that remains. So let's talk about it looking at the raw output. So the blue line here is the raw output of the model, the green line is the stock market. And one thing that I wanted to mention here is that one of the things that you'll notice that's different about the stock market and how its risk levels act versus something like crypto is that the stock market can sustain higher levels of risk for longer. Essentially, once a trend is going in the stock market, once that momentum is there, it can stay overheated for a while before it catches up with it, and it has to have a notable correction. And so what the stock market tends to be denoted by, or the behavior it tends to show, is relatively stable periods of upside volatility and then really extreme harsh periods of downside volatility that then go back into that relatively stable upside. And as I was mentioning, this is different than something like crypto. So this is our UDPI for Bitcoin. So this is I'm pulling off of our website. If you want to see live data from all of our models and more, you can go over to our website, polaritydigital.io, sign up for our Polarity Digital Pro subscription, and you can see live data and all of these charts for yourself. This is the Bitcoin upside downside potential indicator. And what you'll notice that's different here is that Bitcoin's UDPI tends to spend most of its time down below zero, this midpoint. So basically it tends to spend a lot of time where the plausible upside is greater than the plausible downside, and you have these big accumulation periods, and then you get this really explosive volatility to the upside where the UDPI will rip up, but these tend to be relatively unsustainable. You go up, you move up there quickly, and then you have a big crash not too long afterwards. That's the way that crypto tends to manifest, that you'll have longer periods of downside, kind of slower, more even downside, and then explosive upside. Whereas again, if we compare that to the stock market, putting them side by side here, stock market is actually more or less the opposite. You'll have sustained slow periods of upside and then really rapid crashes to the downside, correction to the downside, then slow, steady moves to the upside, so on and so forth. And so when you're interpreting risk for the stock market versus crypto, that means that it's a slightly different interpretation. With crypto, once you're getting up to these high levels, it's suggesting that a crash is probably coming quite soon. At the second you're getting really above zero, and especially as you get higher and higher and higher, you have to get really a lot more concerned a lot more quickly. Whereas with the stock market, you can spend quite a bit of time up at these levels, between 2 and 0 or 2 and the -1 range before ultimately it catches up and you have a big crash, or even spend quite a bit of time all the way up at the highest levels of risk. The dot-com bubble, for example, the market was extremely overextended for a very long time. And that's what, again, I was saying with momentum, that once the stock market gets that extreme momentum, in this case, this strong bubble, it can sustain for a long time, but then it will eventually catch up with you and put in that big correction. And so one of the ways you can interpret these higher levels of risk is that it's a place where you should be paying attention for signs of weakness, but it's not necessarily a sign that a crash is imminent. And indeed, in the 90s, we actually saw this go on for years before we had this crash. And this is something I've talked about before when I was talking about an earlier version of this model applied to the stock market, that you can see that at some times when you have these really strong bubbles, they can last for quite a while before the big crash comes. But historically speaking, that crash will come at some point, and that's why looking out for signs of weakness at that point can be advantageous. So just to flip back up over here, we can look at it a little more closely. I want to talk now about what happened more recently. So what we saw, and actually this is something I talked about as this was happening with the earlier version of the model, was that we did get to this really high level of risk right around here, the top of the market before we had this big correction. So this is basically at the end of 2021 and the beginning of 2022. This was really overextended. And at the time, I had said that it was possible we could do something like this again, like the 90s, and just continue up. But that if we started seeing weakness, it would not be surprising to see a notable correction back to the downside. And that's indeed what we saw. What I think is notable is how much risk has cooled off since that happened. We see that as we went into October, being the lows of the market, at least so far, we cooled down all the way to the same level that we cooled down in after the dot-com bubble burst. And that might seem surprising at first because this was a pretty massive drawdown in the S&P 500. We didn't draw down nearly as much here, and yet risk moved back to the same level. But one of the possible interpretations there was that the market was simply a little bit less overextended than it was back here, that it didn't need to fall as far for risk to reset to the same level. And now we're moving back to the upside. And so does that mean that the rally could continue? Sure, absolutely. It did back here. Now, again, we did then go have the Great Recession, which pushed us all the way back down. But certainly there's room to move to the upside. And as we see with the stock market in these previous points of uptrends, the market can spend a decent amount of time just bouncing between roughly the 2 and -1 levels. We see that it kind of plays in this range often in its history during sustained uptrends, and it looks like it's re-entering that zone. And so you certainly could see something similar play out, where we kind of come up over here, the market corrects again, comes back down, we come back down, so on and so forth. But that could all take place in a sustained uptrend. So that is certainly possible. But at the same time, it's also possible that we could see a big move down. If the recessionists are correct and we see a big recession coming, then certainly you'd expect the stock market to crash, and there's plenty of room to the downside on the EDPI for that to happen. But what that would likely mean is that if we did get that to happen, you just look back at every single time we've gone back to these super deep levels, the deep low levels on the EDPI here. Those have been fantastic buying opportunities. They've marked the lows, the kind of extreme notable lows for quite a while, that have sparked nice big bull markets coming off them. You know, getting down below -3 back here in the 70s, that was the low that ultimately led to this bull run that ended up here with the dot-com bubble bursting. 2008, this bull run that's lasted up until here. And then even back after the Great Depression sparked the run that, with some volatility, ultimately went up through here before we had that first big notable kind of break in the structure to the downside. So those are fantastic dip buying opportunities. And in fact, if we just look at the raw data, we can see this a little bit more clearly. So here what I'm showing you is a table where I've basically broken down by level, so between -5, -4, between -4, -3, etc. So basically just looking at these different levels of the UDPI going all the way up here. And then I'm just looking at the average yearly return within each of those bands. So between each of these levels, when the UDPI is there, what is the yearly return? So what is the next year return within all of these levels? And what you can see is that it's a pretty stark difference. So when you're in the super low risk level, -5 to -4, which we've really only seen here and here, Great Depression and 2008, massive yearly returns expected there, 60% on average. Now there's a limited data. We didn't spend a ton of time down here either of these times, but that was a yearly return coming out of there. Then -4 to -3, 33% move to the upside. -3, -2, 16, and then 13, and then 10. And then there are two things that are notable once you get above 0. First, you'll note this pretty sharp drop off going down to 5 between 0 and 1, and then really just getting to 2 to 1% all the way past that. Now you might notice that these aren't negative, especially these really high ones. You say, well, what's going on there? If the market's really high risk, you'd expect negative returns coming off that level. Well, maybe not. Really, I think the reason why these are positive is exclusively due to the 90s. that you'll see that when we're up at those really high risk levels, it happened back throughout this period. And so there were some decent yearly returns that happened throughout here. But then, of course, there were some pretty nasty yearly returns that happened as well. And so when you take it all on average, it ends up being slightly positive. But again, what I was saying before is that high levels of risk don't necessarily mean a crash is immediately going to happen. But if there are signs of weakness that show up, you better take them seriously, because massive crashes often will follow. I think more what's notable here, and just more the takeaway, is that anything below zero is, on a yearly return, been very advantageous. It's looked great. Whereas anything above zero has looked pretty poor, especially once you get above the 1 level or up into the 2 to 3 level. And so that's just kind of validation of this idea that the market can still move up at these high levels. It's just that it's maybe not going to be moving at nearly the pace that it would at these lower levels. And that's, again, where when you look at this, it might be the case that when you're within these ranges, it's kind of the dip buying opportunities that show up here when you dip below zero. And then maybe places where you're nearing a local top and you might get another nice dip buying opportunity a little bit later. So I think we're going to have to look for going forward from here on the stock market is, what do we end up seeing happen here? Do we see weakness? Because again, we did reset risk, but this doesn't mean that this is over, that seeing a high level of this risk can be worked out of the system so quickly. And so I still think it makes sense here that given this reading that we just saw of such extreme high overextension, that we start seeing notable weakness of the stock market, to take it seriously, that it doesn't mean that we have bottomed here. But it is also notable that we did reset risk so far. Again, back to the same level after the dot-com bubble burst, for example. And so that would not make it impossible for us to be able to go in and put in a new uptrend. I don't think it would necessarily be as rapid as something like this, and what we just were looking at would tell us that's the case. That it's unlikely from these levels being -1 to -2 that we're going to be seeing a 60% rally in the stock market coming off of this. But decent returns off of this level are not unprecedented, and so relative to that bottom, we might see something decent. And in fact, that's exactly what we're seeing, that come next month, October, we're going to be a year from that low. Stock market is currently up about a little over 20% from there. That would be exactly in line with what we'd have expected based on this. In fact, that would be beating the yearly average from that level. But now that we're up between 0 and 1, we might expect a relatively less exciting move. Now, we can still move up. 5% would not be nothing if we hit the average over the next year. But it's probably, from this perspective, unreasonable or unrealistic to think that we're going to be getting these massive returns in the next year. And so a slower grind with some volatility might be more reasonable going from this exact level. And so the final point I wanted to make here of why we would care about this being a more crypto-focused channel is that, of course, when the stock market tends to do well, that also tends to be when crypto can do well as also. That crypto tends to go in sync with broader markets. Not exclusively, it can decouple at times, and it can certainly run much harder than traditional markets in bull markets. But you would much rather have a healthy, uptrending stock market than a crashing stock market when it comes to crypto. And that's where I think it can be useful to watch things like the stock market, how risky it is currently, and where things might go next. So this is still a model that I've been playing around with, still tweaking, but I thought it was interesting and worth sharing. And certainly the different versions of this that I played around with have had a consensus that this was a really high risk point here. And so I think it'll be interesting to watch how the market reacts off of this. If this really is enough of a correction to be able to allow us to go back to the upside, or if there might be some more pain to come. And so my current footing is I think that it's too early for people to be saying that we have to crash from here. But just based on what the risk levels are saying, that doesn't seem like it has to be the case. But if we start seeing signs of weakness, and certainly if we see signs of a recession kicking in, that would be a sign of warning. But then the good news of that would be that if we do get back down to these low risk levels down here, history tells us that might just be a massive buying opportunity that sets us up to be in these yearly return levels that are quite nice. All right, obviously none of this is financial advice. You should make your own opinions and your own interpretations of the data. And if you like the content, remember to subscribe to the channel, give the video a like and follow us on Twitter. A lot of updates, indicators, and more over there. And check out our website, partydigital.io, to see live data from our models and more.